All right, all right, all right. Here we go. We're ready to rock and roll. Here come the markets. Look at this. 7:25 right on the bell. Look at those markets run already. How come they're running at 5 minutes before the bell? 7:26 and 52 seconds. All right, we're getting a little bit of movement, a little bit of motion out of here. Welcome, welcome, everyone. Hey, look at there. Matt's back in the house. It's good to have you, Matt. We missed you yesterday and the day before. So it's good to have you back. And there's Bruce saying hello. Camilla saying hello. I like this other banner better. Let's go see. Maybe it's this one. Comments. Yeah, that one's nicer. A little bit bigger. All right. How you guys doing? It's good to see you. We got a bunch of people in the house. If you guys want to say good morning, we'll throw you up here on the screen before the markets start to run, the ponies start to go. Quinn saying good morning. Good morning, Quinn. We got Larry McIntosh popping in from the class. Going to see you tonight, Larry. Looking forward to that. All right. I've noticed in the stats on my YouTube channel, we got a whole bunch of people who come and watch our classes, but they don't subscribe. It's like 75% of people who come and attend on a regular basis don't subscribe to the channel. Why don't you guys go ahead and subscribe? Hit that little ring, that little bell down there so you get notified when we're doing a class. I know it's almost every morning at 7:30. Lately, it's been every morning, 7:30, every market morning, 7:30 in the morning, but you should still put that little bell down there. There's G Wiz checking in with us. Happy trading day. It's Friday. So Fridays are usually pretty good days for me. I usually have good days on Fridays. So we'll see what's going to happen. We're going to spend most of our time looking at options. I know it's options time. Matt, you've been missing the options trading. But maybe that's why you haven't been able to attend. You're just like, wow, I'm not interested in options. But we've been having fun with options. So if you want to see a little bit about options, you guys can go back and watch the previous sessions and join us in the options class. Tonight, we're going to meet at the university, and we're going to have our final options day, and we're going to learn about some really important steps. We're going to learn about the intrinsic value, the extrinsic value, but most importantly, we're going to learn about the theoretical value of options and the Greeks. So we'll learn about that tomorrow in the lab, because I'm not going to jump ahead of the university class, because I want to, this class, of course, as you all know, is to review the university classes. This is the lab for my university classes. For those of you who are near and dear to us, you already know this, but for those of you who are new, and we do get some new people every day. My stats say new people check in every day. And so we always like to have the new people come and join us. My name is Lan Turner. I'm a former instructor at the Chicago Mercantile Exchange and the Board of Trade's Education Center. That's the little feather in my cap. I'm currently an instructor of finance at Utah Tech University. All right, so that's what I'm doing. And this is the lab for that class. And in that class, we teach the academic side of things. We go in there, we study, we talk, we go into great detail into some of the academic side of things. And then because the markets are closed at night, because I do teach night classes, I like to come and work with my classes in the morning when the markets are open. Is that the opening bell? That's not the opening bell, but we're 7 seconds away. Look at it go. Let's get rid of this thing and bring it up larger screen. Here we go. Let's let the ponies run. You know what? It might be better if I stuck myself over here. That way we could see the Russell a little better. Still getting used to this. This is 53 classes. This is our 53rd time I've had these labs. 53 labs. How about that? Pretty crazy, right? Still getting used to trying running this YouTube software. I got two screens. I got the screen I focus on, which is right here in front of me. This is the screen I focus on. And then I got the YouTube screen. It's over here. And so it's out of my sight. It's out of view. And I sometimes remember I got to go back and forth to these so I can make sure I'm doing the right thing and seeing what you guys see and not just what I see, because they're different a little bit. All right. The bell's open. So that's the opening bell. Not a very exciting opening bell. Now remember, as I always say, this is just Daddy and Mommy come home from work at 6, 7, 8 o'clock at night, have their dinner, sit down on the couch and start playing on their little iPhones and start buying up Microsoft, selling some of their small caps, right? Buying and selling stocks. But their orders don't go through at night because the market's closed. And so when do the orders go through? Bang, on the opening bell. That's when their orders go through. And so you have a whole bunch of orders that get filled for Mommy and Daddy trading in the middle of the night. They go up and then they say, oh, there's a whole bunch of people that sold some too. So flushes back down for all the people who sold them. And they start matching those orders up and the market goes all over the place. And that's what's happening here on the opening bell. It's just a whole bunch of nighttime orders getting filled. Doesn't mean it's a trend. It just means that in the middle of the night, there was either more people who bought than sold, and so the market goes up, or in the middle of the night, there's more people who sold than bought, so the market goes down. But they got to match all those orders up. And sometimes there's a lot of orders, sometimes there's not as many orders. So the morning bell can be really crazy and last for a long time. Sometimes it takes them 10, 15 minutes to fill all those orders and get all those things backed out and put to where they need to be. Sometimes it happens pretty fast because there's not a lot. Maybe it only happened a couple minutes or 5 minutes. And then once that's all cleared out, the market can kind of decide which direction it wants to go. And it can start to trend. Sometimes it trends right out of the gate, right? We have in the middle of the night a whole bunch of really good news the day before. Daddy comes home, Mommy comes home and says, oh, I saw Microsoft had good earnings. I'm going to buy some of that. So they buy some stock and, because of the good earnings, more people bought in the middle of the night than sold. And so the markets just trend right out of the opening gate and away they go. But that's more rare than usual. Usually we get kind of a whipsaw pattern. It goes all over the place. That's why I don't generally trade the very opening bell, but we like to wait 5-10 minutes, get ourselves some kind of a channel, see what the market wants to do, and then see if we can't pick up on a trend. Looks like it's going to be bearish right now. Bearish, of course, the word bearish means that we think the market is going to go down. Bullish means that we think the market's going to go up. If I'm bullish on the market, I think the market's going to go up. If I'm bearish on the market, I think the market's going to go down. If we call it a bull market, that means the market is going up. If we call it a bear market, that means the market is going down. All right. And then there's specific technical tools that we use to tell us confidently that the market is in a bull market or is in a bear market. Definition of an uptrend is higher highs and higher lows. Definition of a downtrend is lower highs and lower lows. So if we're making lower highs and lower lows, we're in a bear market. If we're making higher highs and higher lows, we're in a bull market. All right. And then we generally do that on a longer term time frame. We'll out on a daily chart for the most part. So these guys, sometimes you'll hear them on the internet or these market analysts. The market has switched. It is now a bear market. And there's other indicators that they use besides that. But technical analysts, for the most part, we have mathematical models that we look at. And we know, hey, based on this mathematical model, we are in a bull market. We are making higher highs and higher lows. We're making lower highs and lower lows. And you can learn that. It's a process of recurring price patterns based on the Elliott wave pattern. So the Elliott wave drives ABCs, 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 higher highs and higher lows. And then when that turns around, we get a head and shoulders formation, a topping pattern, turns around, comes down, starts making lower highs and lower lows. That would be a changeover. And we would now, once we break and now have a confirmation of lower highs and lower lows, we are now in a bear market. All right. So that's how that works. And you can do it on a smaller time frame as well, not just a long time frame. We can do it on a daily chart. Now, right now, what we're looking at is we're looking at a 1 minute chart. So each bar represents 1 minute. Okay. So it's the open, high, low, close for a 1 minute time frame. And then we get a new bar, which is the new open, the new high, the new low, and the new close. And through that process, the market makes patterns. Okay, they go through patterns, little triangle formations. You'll see a convergence of price. We also have head and shoulders formations where the market will go up and switch from up to down. We also have 1, 2, 3 or ABC patterns. That's my favorite. I like to trade the 1, 2, 3 or the ABC patterns. I like to let the A pattern go to get a little pullback and catch that C to D. So prove to me that you want to run a little bit. Prove to me that you're not just having a false breakout. Give me 3, 4, 5 bars, and then give me a little pullback. I just want to see a little two bar pullback, and then start to break. And that first break to the new high, jump in and ride the next leg up. Sometimes we don't get that next leg up, and it's just a weak market. And so we suffer a little loss in that attempt. But the whole name of the game is cut your losers short, let your winners run. The big money's in the longer trends. So you want to see if you can't take those longer trends. But there's a lot of scalpers in these markets. And as we've seen in days past, sometimes the market will take off and break out, but then it'll pull back and flush right back. That's because those scalpers are taking their profits from a little tiny move. Sometimes it's frustrating because those guys will just take their little profits. They're happy with $50. They're happy with $100 per contract, and they jump right back out, and the market flushes back down, hits our stop, knocks us out, only to turn and rally once again. And that's the frustrating point of it. So sometimes that's why I'll let that first run go by, let those markets go, those scalpers jump out, and then I'll get in on the next run. So it's a timing issue. It's a game you have to play. And there's a lot of strategies. There's a strategy called the Christmas tree, and another strategy that we call the Balaam's ladder. And those are actually being published in Pit News Magazine right now. So in the December issue, there's some great articles about Balaam's ladder and the Christmas tree strategy. Now, we traded the Christmas tree strategy the other day. I would say very successfully. For those of you who were there for that, we didn't make a lot of money, but we didn't lose any money. We made a little bit of green, but we spent the whole almost 30, 35, 40 minutes in that trade and never lost anything. And the market went completely against us, an entire Elliott wave pattern. Now you're like, well, what was successful about that? Well, we traded an entire Elliott wave pattern going the wrong direction because we thought the market was going to go up, and it flushed lower, and we still made money. That's what's amazing about that. All right. Got my morning tea because I keep losing my voice. What's going on? Let's go look at the markets. We're sitting here jibber jabber and talking. We're not paying any attention to what's going on. These white lines are from yesterday. And I leave those on there because I think it's important to see that yesterday, this was the high bracket and this was the low bracket. This market is trading right back dead center of yesterday's high bracket, low bracket. Where's this one? This one, look at this. This is the Dow coming right back into yellow yesterday's opening bracket. Remember, we bracket the high and we bracket the low of the morning session, and we put those white lines on there, and they stay, because I didn't delete them, they stay all day long and come in the next morning. And look at that. This market is dead center right now. That Dow is dead center of where it started out yesterday. It has not gone up. It has not gone down overnight. What about let's see, do we still have, oh, look, here's the lines from yesterday. One of them. We might have deleted the others. But there's one of the lines from yesterday. So the market has actually fallen as far as the NASDAQ's concerned. Here's the line from yesterday on the Russell. Look at that. There's the morning session neutral zone, the bracket from yesterday. And the market is trading just barely a little bit below yesterday's bracket. So it fell a little bit. The S&P, same thing. That's the bracket from yesterday, and we're just touching the low of the bracket from yesterday. And that's really important to keep in mind because we're going to start doing options. We're going to day trade options in the futures market. I know, sounds fun, right? Sounds aggressive. It is, but we're gonna do it, and we're gonna do some neutral option strategies. We're gonna trade some iron condors, and I'm going to show you that when a market does that kind of thing where it just goes flat from day to day to day, doesn't make any money, you can make money with the iron condor. All right. So we're going to get into iron condors in the futures market, and we're going to trade some 0 DTE. If you've ever heard that term, 0 DTE stands for 0 days till expiration. Now we know that when we're looking at options, we have to pick a time frame in which we want our option to last. How much time do we want to buy? Well, when you do a 0 DTE, it's a 0 days till expiration, meaning it's going to expire today. So you got to make your money today because that's all the time you got. All right, we're going to do that in the futures market on some of these market. Not that you can't do it in the stock market. You certainly can. We can do some zero DTEs in the stock market, but we like to do them in the futures market because that's where we day trade, right? We like to day trade over here. All right. Look at that. Look at that Dow drop. Did we even get an opportunity to get into that thing? What time was this? This was 7:25. So this first arrow, everybody always said, "Oh, Lan, why don't you just trade the arrows?" Well, that arrow was 5 minutes before the opening bell. That arrow came in. What was that arrow? 7:20. That was 10 minutes before the opening bell. We got a little flag formation right here. It's easy in hindsight to look back at that and say, "Oh, shoulda, woulda, coulda." Why didn't you do this, Lan? Why didn't you do that? Why didn't you make this money here? Why weren't you're not a very good trader? You didn't make $1 million today in 5 minutes like that other guy on YouTube. We got an article coming out about those guys too on in Pit News Magazine. I don't want to tip my hand too much to that article. We got 2 articles coming out about what you need to be careful and watch for in this industry. This industry is full of shucksters and scammers. We got to be careful. Got to be careful. So we got 2 articles coming out. I don't know. They're not both coming out in the December article. The first one is just a gentle one. The second one is a little bit rips some people's wheels off. So I think we'll publish it. All right. So here the Russell. Matt, what do you think of that Russell? Let's come in here and see who else we got in the room. G Wiz said hello. We said hello to G Wiz. Happy trading day. And Matt's coming in here, says, I love options. I took a little trip with my family for a couple of days. You're not allowed to take days off, man. We miss you here. Just kidding. Hope you had a good time. You went to Florida last time. Matt's traveling around. Do you trade when you travel, Matt? Do you take your trading travel thing? I don't. When I travel, I don't trade. I don't. I know a lot of guys are like, oh, that's the great thing about trading. I can day trade on the road. I go on vacation and trade. I can go out and trade on the beach. I can't trade when I travel. I have to be focused. I'm like, I got to sit here. I got to have I got my thinking spot. Do you guys have a thinking spot? It's kind of a psychological thing that people talk about. It's like, when you work, you have your office and you go to your office and you work and you get used to working there and you can think and you kind of get into your mode and you kind of, go into another world. And then that's where you can think and get things done. And if you try to do that or be creative or do your work outside of that thinking spot, it's kind of hard. It's difficult to get your brain wrapped around it. I know there's a lot of guys that like to take their travel stations. One of my mentors loves to, I have a mentor too. I have a lot of mentors. Been doing this 30 years. I still have guys that I listen to and talk to. One of my mentors, he likes to travel. He goes traveling because that's what he does for a living. And he trades while he travels. I can't do it. I don't do it. When I go on vacation, I go on vacation. I leave this stuff behind. I need a break. I need to get away from it. I need to think about something else, spend time with my family. I'm not trading. So it's hard for me to trade. I don't generally, I usually lose more money. And then that screws up the vacation, right? Because if you have a bad day trading, you lose $1,000 that morning, and then you're like, okay, let's go out to dinner and buy a nice dinner. No, I'm not buying that dinner. We're going to McDonald's today. We were going to go to the buffet, but I just lost $1,000 in the market because I was trying to day trade on vacation. We're going to McDonald's. And so it screws up your vacation. So I don't do that. Another point, while we're talking about this, I think I ought to throw in, the markets aren't doing a whole lot. Can't make a lot of trades. So I just give you a little bit of Sunday school lesson. I had a friend, one of our students at the university, became a pretty good friend of mine. Trader, started trading, had a bunch of trades on, and had his stops in and everything, but I guess he didn't have his stops in. He wasn't trading with stops, or he's trading with options. I'm not exactly sure what happened, what he was trading, but he went into the doctor to have just a simple day procedure. Right. He was just going to go in, get something done, and then leave and come home that day. And he went in and he had a reaction to the anesthesia. And he ended up in the hospital for a week, sick, couldn't get back to his trading station. And when he came home, he lost like buku bucks, lost a whole bunch of money because he hadn't properly set everything up so that if there was an accident like what happened, which he had no intentions of having happen, that was a bad move. So the lesson there, the Sunday school lesson on that is, always set up your order so that if something happens and you can't get back to them that day or for a couple of days, that you've got protection, stop orders, you've got, options set up so that they're not going to kill you if you come back and, just prepare for that kind of stuff. Trade wisely, trade smart, make sure you got your protection. And a lot of guys don't trade with stops because they're like, oh, I don't want to get stopped. They see the stops, they chase your stops. They're going to come back and stop me out. I'm not going to trade with stops. I told you the story where my buddy was sitting there trading and he didn't have his stops on, not even a parachute stop. And his daughter came in with a nosebleed and ended up with a $600 nosebleed because he jumped up, ran off, helped his daughter, came back, and he was down $600. So he didn't have his parachute stop in. And so market just tanked against him while he was off helping his daughter. So that's not very cool. Okay, we're getting ready to go long here, are we? Or is this just a rebound to the downside? This market's making a reversal. Looks like it wants to go up. We got 1, 2, 3, 4 flat bottoms. We got nothing on the Russell, Matt. Look at your poor Russell. Matt says he did trade when he was on vacation for the first hour of the day. So you're braver than me. I just don't do it. I'm not good at it. I always lose money on vacation trades. All right, S&P 1 minute breaking above the green. We got our arrow. I want to see this thing. It's got a nice rally bar up there and it's pulling back. So we want to see it just pull back a little bit more. Let's see it drop back. I'd like to see it break. There we go. That's our signal right there. Not a very good one, and I missed it. We're going to take it with one signal here. We'll see if it wants to continue to go at this point. We may have had to decide to. No, they're suckering us in. Come on, buddy. Run, run, run. Run, run, run. Zoom, zoom. How many of you guys are dog owners? You guys have dogs? You take them out. I take my dog to the park, and there's a sandy spot in the park that's underneath an overpass, and there's a little creek running through there, and it's nice and cool. You get down there, and the sand's always wet, and my dog goes crazy under there. Zoom, 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 zoom. He zooms all over the place. He runs like crazy. Call it zooming. He's zooming, zooming. Come on, market. We need you to zoom, zoom, zoom right now. Failed on us. Figures. Typical. That means that could be a downtrend. That means we could have a failure and this thing's going to continue down. I was looking for it to break that and continue higher, and it didn't do it. So let's see what it does right here. It's going a little sideways. Which direction's it going to go? Which direction's it going to go? It's not giving us the opportunity to bracket it and take it either direction. It just came down, broke down lower. This might be the rally for the upside. We give it one more shot in here. See if it's not going to continue to rally. Watching the small chart in the upper right-hand corner, wanting to see some green on the tape. Remember, the guys are always yelling on, screaming at their screens in the morning sessions. You watch on YouTube, oh, there's green on the tape. There's green on the tape. There's red on the tape. That's the tape for the track and trade software. It's up there in the right-hand corner. We chart the tape. We don't just show you buys and sells in greens and red colors. We actually chart the tape. So that is the tape up there in the upper right-hand corner. We chart it so you can, oh, look, the NASDAQ's running, but that Dow's dying on us. We're going to get stopped out on a second time for the Dow to the long position. All right. That's it on the Dow. That's 2 strikes on the Dow. We haven't got 3 strikes and you're out yet. That market started to rally and then it died. We could probably, say put our 3rd strike in there for the short side and say this thing's going to fall out the bottom. That could be what happens with this Dow. All right, we got our 3rd strike in there. If it fails on us this time to the downside, we're going to go start trading options. Freaky Friday. Come on, Friday. You want to go? That's two bar. I don't like it. We're going to do 1, 3 up. I still think it's going to go long. All right. We're going to play the reversal game here. I think it's going to move. I think it's going to go one direction or the other. So you're going to break out of this little triangle formation and go long, or it's going to break out and go short. We don't know. So I got 2 long at this point. That'd be 5 to the downside if we wanted to reverse it. This is where you get your hiney handed to you. The market just goes back and forth, doesn't do anything. You keep trying to get into the market, out of the market, into the market, out of the market. Land, don't do that. Don't do that. I know. Come on, buddy. We're 3 short now. We reversed it twice. Come on, push through there. What do we do when we get behind like this? We have to recover, right? We have to recover. Down 295. We need that to be at $300. That's going to be a tough recovery. It's going to have to come down and test that previous low to just get our money back. Come on. Get off the pot. Get off the pot. It's not going to do it, is it? Look at that little tiny chart up there. There's no green. There's no red on the tape. It's just neutral, neutral, neutral. Just going sideways. Getting our butts kicked right here on the sideways trend. And then you know what's going to happen as soon as we bail out and say, well, 3 strikes, we're out, we're done. We lost our $500. That's when it takes off and makes a new run and goes crazy on you. We got a parachute stop in there. I'm holding it back a little bit because I don't want to keep getting whipsawed back and forth, but I want to take a big risk on this one because I got three contracts on. 3 contracts to the short side. Boy. Oh, look, and everything else is running. Everything else started to go. We can't do that. Oh, that was a mistake. Oh, maybe we'll capitalize on it. Everything else is going. Look at the NASDAQ. Look at the S&P. The Dow. Come on, Dow. Oh, my goodness. Oh, my goodness. You rotten little son of a bee. Oh, you little pieces. You know what? We're done. I ain't trading the Dow no more. Goodbye, Dow. You. Look at the NASDAQ. We should have been trading the NASDAQ. We'd be rich, rich, rich beyond our wildest dreams. I trade the Dow. Why do I always trade that stupid Dow? Because we were going to trade the Russell, but the Russell's not doing anything today either. Oh, my goodness. Oh, my goodness. I'm going to have to. Okay, let's go look at the options. We could take a break from this market. Let's look at the news. Let's look at the news. All right, let's see. Brian says he's here from class. Nice to see you, Brian. Wonderful to have you in class. We got a few more guys we'll say hi to. We got Oliver. Good morning from Oliver. Matt says he did trade the first hour on his vacation. We got Oliver again. Bias. I guess today is long. Well, it's not short or long. Not when I trade it. It's just dead. And I just got whipped. I tried to do a little reversal, whip myself back and forth into a frustration, so I can't trade anymore. I've met my level of frustration. That's enough for me. I'm going to wait. Maybe I'll come back at 10 and see if we can't do something better. All right. So I will give it a try. ATR R50 past my EMA 28. Oliver says he's getting ready to take a position. Loves the NQ. Did you make some money on the NQ while I lost it all on the Dow? I trigger new EMA past the ATR signal. So, Oliver, you making money? Not saying. I didn't. I got my hiney handed to me this morning on that stupid Dow. Should have been trading the NASDAQ. Oliver, you should be making. You should look at that. It came right back to the little blue line. Right back to the look. Not a single lower low. That stupid NASDAQ was the one we should have been trading. That thing took right off and went all the way back up to the VWAP. All right. Turn it back on, Land. Go see what you're. Go lick your wound. Oh, yeah, of course. As soon as we got out. As soon as we got out, the Dow took off and went to the moon. Oh, no, that's the daily chart. Oh, look, it's still dead. It's still dead. It's trying to break lower now. There's it breaking across the green dots to the downside, but it's just dead. We got to turn the Heiken-Ashis on, bring this one full screen, turn Heiken-Ashi on, bring it back. Look at that. What a frustrating day. What do we got on the news? What did we say we were looking at on the news? 6:30 this morning, we had our building permits came in, but that was good news. Building permits, consensus was 145, previous was 1.47, the actual was 1.48. Forecast was 1.45. So building permits went up. But that happened at 6:30. All these 6:30 housing starts were all good. And then we hit 7:45. Oh, there he is. Fed Goolsby started to speak when I started to trade the Dow, and that's why it died. Thanks, Goolsby. Goolsby. That's a perfect name for a guy that works at the Fed, isn't it? Look at that. That guy's name is Goolsby. He's a ghoul. He works at the Fed. Oh, my goodness. How is that not appropriate? We got Daly speaking here at 8. We got Colin speaking here at 8:15. So 8 o'clock, we got Goolsby is still speaking. The ghoul is still speaking. Baker Hughes oil rigs coming in at 11. That's where I'm going to go make my money back. I'm going to go trade crude oil at 11 o'clock. We're going to be superheroes after that. You wait and see. All right. So let's go back. Look at this. Look at that. Still dead. Goolsby killed it. Goolsby killed it. And I fell for it. Oh, my goodness. Oh, my goodness. Oh, my goodness. Oh, my goodness. All right. Let's go over and look at the stock market. All right. These are options that we are just learning on. Now, it's always nice to be able to make money, show a profit when you're practicing with your options. But that wasn't necessarily the goal. It was just a convenient time to put the options on for the class, for the lesson. They just happen to make money, some of them. All right. And sometimes it's not even a great lesson when they make money. It's sometimes a better lesson when they lose money. But we're going to go through and we're going to review what we did, and then we're going to put some more options on. And then tonight we're going to talk about some additional things that we can add to this. One of the things is the theoretical value and the Greeks. And I'm really excited to talk about that in class tonight. So tomorrow, don't miss class tomorrow here, because it'll be the lab for the Greeks and for the theoretical value of options. And you've got to know that. So don't miss class tomorrow. Oh, Monday. Not tomorrow. Tomorrow's Saturday. Are we going to cover? No, we're not going to cover Greeks. I'm going to cover Greeks in class tonight. So on Monday, make sure you are in class, because if you have any interest in options at all, it is a super important class. You have to know this. If you don't know this, you can't trade options, period. And there's a lot of guys that trade options without this knowledge. And it's like shooting in the dark. So you got to know what we're going to learn tonight in class. Don't miss class tonight. Don't miss class on Monday, because we're going to talk about a very important component piece to options trading. All right. So let's come in here and look at what we've got. This is, let's go to all, and we're going to go to the multi-leg options. Now in track and trade, it's very much designed to work around the options. So it's a very nice, beautiful options trading platform. And so what we've got is we got the ability to look at these as open positions, which are just all of our open orders. But then you can come down here and you can sort on the left-hand side. We can see multi-leg options. So we can see all of our multi-leg options. And you can see they're all on one ticket, which is on one ticket. So when we put this one on Apple, let's go to Apple. So this is our Apple trade. And when we put these on, we put all 4 of these on just as an example to see what they were doing, right? Out of the money, in the money. So we actually put on 4. This is deep in the money. This is at the money. This is out of the money. And this is deep out of the money. So we have a deep in the money, at the money, out of the money, deep out of the money. And we just put all 4 of those on just so we could watch them and see what happens when the market moves. Now, in this case, the market continued to move in our favor. It started to rally, so it's moving up. That's good. That's nice, right? So we're going to come in here and we're going to go just to the individual chart. So in our accounting, we're just going to look at the one chart that's active. And what we've got down here is you can see all 4 of these orders on one ticket. So they're all together on one ticket. So what we've got is we got the total across the top is all of it combined. So you got your gain, you got your cost value. So the cost of all four of those combined was $2,929. Now remember, when we trade an option, when you buy an option, people get really confused on what's going on. Selena saying my screen is not so clear. I am broadcasting at the highest screen resolution that I possibly can. It is a 1024 by 760, or it is not 1020, it is 1080p. That is the highest resolution that YouTube lets me project with this projection screen. So it is the highest resolution I can give you. And it's 1080p. I don't know what to do to make it higher resolution. That's the best I can do on over the internet. I apologize. I wrote into the projection company, the software that we use, which is I use a company called StreamYard. And I wrote them and I said, I need to be able to zoom and pan. I need to zoom into what I'm talking about because I got this whole great big monitor and we're talking about this one little component piece of the software. I need to be able to zoom and pan. I can do that when I make a video. I can zoom in on certain areas and pan in. I can't do that on a live session. So there's advantages and disadvantages to being live. One is that you can ask me a question like that and I can answer you right now. If you were watching a video, I can't do that. But that's the situation. That's the technology that I've got available to me. If anybody knows any live streaming software that lets you zoom and pan while you're live streaming, let me know and I will switch to that software. But for now, I just use StreamYard, and that's everybody I've talked to says that that's the best software for what we're doing. So I did write them and tell them I need that feature. So I apologize, Selena. That's at this point the best I can do. Don't know what to do for you to make it better. I know it's a little, the green is a little dark against that dark background. I mean, it looks great on my screen, but I know on the YouTube video, it's a little small. I don't know. Anyway, let's get back to what we were talking about. I apologize for those of you who have a hard time seeing what I'm talking about. Don't know what to do. I wish I could do something. But our cost basis on all four of these options. Now, again, this is not some fancy option strategy. It's just simply buying 4 calls at different price levels so that you can see them. Now, when you buy these options, remember, you have the right but not the obligation to buy the underlying, to exercise your right and buy the underlying stock at the price, at the strike price. And the strike price, Selena, I don't have the ability to change the color of that. That's the system color, and I can't change that to make it brighter. Maybe I'll talk to the programmers and see if I can get them to let me make those green colors on that black background brighter. If we could get it the same color as the green ticks, that would be nice, but I don't have controls on that. I don't think. I'll check and see. Maybe tomorrow I can figure it out. So our concept here is that these options were just put in there. They're the right, but not the obligation to buy the underlying stock. Okay. And so in that situation, a lot of people get confused, and that's where a lot of this confusion comes from, because if you actually exercise your option, you would end up having to pay, in this case, the market's currently trading at $189 a share on Apple. You'd have to put up $18,950 to exercise your right, because each option represents 100 shares, right? So if you have an option, then you don't probably, for the most part, we as small speculators, we're not going to actually exercise our right and put up the $18,000, $19,000 that we're going to need to put up to take the shares. Not that you can't. You certainly can. You can exercise your right and take their shares if that's what you want to do. And sometimes it makes sense to do that, but sometimes it doesn't. So most times it doesn't. So for us as small speculators, when we are trading and we are trying to build our portfolio, what we do is we just think of the premium of the option as our investment amount. We're going to invest into the market however much the premium is. Don't think of the $18,000 for 100 shares. That's how much leverage we have with the option. The option is going to either increase or decrease based on those 100 shares. Now, we're going to get into Delta. And again, I'm not going to introduce Delta to you today, because we're going to introduce Delta in class tonight, and then we'll introduce and start working with Delta on Monday, and I'll explain how delta works along with the Greeks, because delta is part of the Greeks. So we're going to get into the Greeks. We're going to talk about those, and then we're going to learn about delta and how this market works in conjunction with the Greeks. It's really super important that we understand that part, but I'm not going to cover it today. So I'm just going to review these options that we got here, and maybe we'll go look at some other stocks. If you guys have some stocks that you love and want to talk about, put them into the comments, and we'll switch over and we'll look at some stocks. I got some lined up for us that we're going to go look at. We're going to analyze and maybe put some options on them. And in the meantime, let's just review what we've got. And so the at the money option, this one was at the money when we bought it. Okay, and we paid $870 for that option. That was our investment into Apple. Again, we're going to think of the premium as an investment. Now, I know that it's not really your investment dollar amount. It's the premium you paid for the option, but that's our investment. Think of it as your investment. So you invested $870 into Apple. If the market rises, if you buy a call, right? If you buy a call, you expect the market to go up, or you want the market to go up. If you buy a put, you want the market to go down. That's all. There's only two types of options. There's a call and a put. If you think the market's going to go up, you're going to buy a call. If you think the market's going to go down, you're going to buy a put. And so these are the four options that we put on. We just bought 4 calls: in the money, out of the money, at the money. And this one that was at the money, the market has risen since we got in there. And so it went up. How much has it gone up? That one that we paid $874 for, which was at the money, has now gone up 10%. Okay. So $965, it's up $95. So that's a nice little win for us right there so far. So it's up 10%, almost 11%, 10.92. Now remember, a lot of guys they're happy with 5% a year on their money. 5% a year, right? You'll wait a whole year to get 5%. Oh, I got a CD. It's 4.9%, but I have to hold my money in the bank for 6 months or a year to get that money. We just made, in what is that? 2 days? 3 days? 1, 2, 3. 3 days, 11.49% on our $970 with an option. That's why I always tell people, be real careful when you're trading options. Because if you can make money fast, you can also lose money fast. You can lose 10%, 15%, 20% of your money on an option just like that. All right? So we want to be very cautious and careful when we put on our options. Don't get crazy. Don't go wild. Be very careful. You can make a lot of money with options. You can make as much money in 3 days on your options as some people will make in an entire year. So we don't have to overtrade them. All right. So the point of trading options is that you're very, very careful with when you put them on. Now, we're all very well trained at this point. You've watched my classes. You know about the accumulation distribution model. You know about the Wyckoff theory. You know about Elliott wave. You know about Fibonacci. You know how to do all those things. Those things have never been more important in your trading world than when you're trading options. People don't often think about what the underlying stock is doing when they look at options. They just look at these mathematical models or these calculators that are in their software, and they go, oh, I'm going to put on an iron condor. Why? Because when I pushed the button, it said I was going to be rich, rich, rich beyond my wildest dreams. I'm just going to do that. I have no clue what an iron condor is. I'm just going to put one on because it says I'll be rich. And then they lose all their money. You have to do technical analysis. You have to be a good chart reader. You have to understand these models when you trade options. And the reason is because it's the movement of the underlying market that changes the value of the option, either increase or decrease. And you've got a certain very limited amount of time for that to happen. And if you pick wrong, bam, you're going to die fast, because an option is a decaying asset. The minute you buy it, it starts to lose money. The minute you buy it, the second you click that button, boom, it starts to lose money. And I'm not talking about losing money because the market's going down. It's decaying in time. Remember, we have 2 types of value that make up an option. We have intrinsic value and we have extrinsic value. Extrinsic value is the time value. I call it the opportunity value. All right. An opportunity value immediately begins to die the minute you buy it. Your opportunity to make money with that option, it immediately starts to go away, because time is your opportunity, and time is limited on these options because you select how much opportunity time you want to buy. And the more opportunity time you buy, the more expensive your option is. You don't want to buy more time than you need, But then you say, well, I don't know how much time I need. If you don't know how much time you need, then you shouldn't be buying options. That's the point that I'm trying to make. I'm trying to save you, Heine. All right. You need to be good at this. You need to understand that a market moves through waves, A, B, C, D patterns. It moves up, it moves down. It makes these movements through price and time. So when we're trading the options, the market moving up is going to increase our call option. But is it going to increase it faster than the time decay? All right. So that's an important point. We're going to come down here and look at the table. I'm going to pull up this. We're looking at the 63-day options. So we're going to come in here and look at 63 days. And you can see all 4 of these options that I've got in here are listed in green. So 1, 2, 3, 4. And then the yellow line is the at the money. That's the current market price. Now, this one here is the one we bought. We paid $980 for it. And immediately we got a column in here that tells you how much money you're going to lose every single day. Right there, $15.56. Can you see it? I hope you can see it. It's right there. This column, premium per day, is what that's telling you. That's $15.56 per day that you're going to lose in time decay. Well, what does that mean to me? Well, that means that the market has to move in your favor when you own an option. It has to move in your favor. Which one of these columns is making this thing jump? It's not the right size. It has to move in your favor by at least $15. All right, to be profitable, because you're going to lose $15 every day in time decay on average. Now, this is just an average. It's not a perfect curve. It's just taking a straight line average. So on a straight line average, you're going to lose on average $15 a day in time value. Okay. And so if you have an option that is out of the money, there is no intrinsic value in it at all. Zero intrinsic value. What is intrinsic value? Intrinsic value is the amount of money that's in the option from the point in which you purchased it to where the market is currently trading. So in this option right here, when we bought it, it was at the money, meaning it had no intrinsic value. It had no and the only thing it had was extrinsic value. So if we take our dollar calculator and we go from where the market, when we bought that at the money option, up to where the market's trading, it has $500 of intrinsic value. Now, not exactly, because we got delta involved. And again, delta is one of the Greeks, and we're going to talk about that tomorrow, and I'll show you how that works. But it's got basically $500 of intrinsic value. So if you exercised your option, right? If you exercised it, you have the right, but not the obligation to buy that stock at $185, and it's currently trading at $189. You have to buy 100 shares to exercise. So you'd make $9 per share, 9 times 100, right? That would be your profit if you exercised right now. But it's got $500 of intrinsic value, and the premium of your option went up from from 870 to 980. That's what this is showing you over here on the left-hand side of the screen. It shows you paid $870 for it, and it is now the market value is worth $975. So you are positive $105. Even though you've been losing $15 a day, and we've had it for 3 days, it's still up $105. Okay, because the market outperformed. It moved faster than the time decay. Now, there are definitely times where you can buy an option, and it happens not all the time, but it happens enough that it makes it a pain in the hiney. You can buy an option, and the market will go in your favor. Let's say you buy a call option, and the market goes in your favor, and you still lose money. You're like, wait a second, I'm right. I picked the right direction, and I'm still losing money. How is that happening? Well, because the market didn't move faster than you're losing money on the time decay. All right. You lost $15 on time decay, but the market only moved $10 in your favor. So you actually lost $5. That's how you can be right and still lose money in options. So the market has to move explosively in your favor. It can't waddle and dawdle like the Dow did for us this morning in the day trading. If it waddles and dawdles, you're going to lose money in your option as well, even though it might have waddled and dawdled in your favor. So the next thing we want to look at is this one that's way down here in the money. So we put this thing on, in the money, and we bought, how much did we buy? We bought $1,000 of intrinsic value. And we also bought 65 days of extrinsic value. So that thing was expensive. We had to pay $1,655 for it because there was $1,000 of intrinsic value. Well, you have to ask yourself, well, why in the heck would you do that? Why did you buy all that intrinsic value? You just spent an extra $1,000 that was already built into the market. Why didn't you just buy it at the money? That's a good question, and has to do with delta. Okay, it's going to be a little bit more stable. It's going to be a little bit more stable option, right? It's not going to make as much money, but it's also not going to lose as much money in the fluctuation of the market if you're deep in the money, because your delta is higher. And we're going to talk about delta on Monday tonight for those of you who are in the class. Okay, so that's what we're looking at there, and that's how that market comes out. If we go back over to our positions, we can see that this one that's way out of the money. So it cost us $325. That's this one. This is just a little bit out of the money. We paid $325 for it. Current value is $382, so we're up 17.69% or $57. Now, $57, not as much money as the one ahead of it, which is up $100, but 16% is more than 11%. So that's why I keep wanting to emphasize that when you buy an option, that is your investment into Apple. All right, that's your investment. And determining where you're going to put that option on the scale, whether you're going to go out of the money, at the money, in the money, deep in the money, is going to determine your percent gain return. So in Apple, we just put in $1,655. The market moved in our favor. We made 7%, which is the most money, $115. But that's because 7% of $1,655 is more money dollar-wise, but smaller percent-wise than a $79 investment that made 23% or $18. So we only made $18 on this option that's way out of the money, but that was 23%. Again, remember, bigger risk, bigger reward. All right, so that's what we've got going on Apple. Let's go see what are the other ones. Multi-leg here. I can see just my in the money options. This is kind of a neat little thing. On this software, you can see in the money options, multi-leg options, open positions. There's all kinds of little filters over here that you can set up and have them. So if you're going to roll, you have your 80 delta, all kinds of neat stuff for different strategies. But we're just looking at multi-leg options for all and chart. Okay, so the next one we got is Amazon. Now this one, we're just going to go to multi-leg Amazon chart. So you'll notice that we got two tickets in here. If you look up here, we got three options and we got two tickets. We got one that's got two orders on it because when we placed it, we placed these two on the same ticket. Now a ticket means that when you're placing an order, you got these four entry points over here. If you fill them up at the same time and send in two options at the same time, which is what you do when you're creating one of these crazy option strategies like a straddle or a strangle, that's two options that you're going to order at the same time. Then you put them on the same ticket, and Track and Trade drops them on the screen and draws a line between them. See that little line right there between them? That little line right there shows that those two went in on the same ticket. So if you look down in your accounting window, you see them on the same ticket, meaning that they're going to have one header that's going to add the two together and give you a total for the two, and then it shows them individually so you can see them individually. All right. So now we can see them individually. So we can see that we bought, these are puts. So the market has to fall to make money. So we bought one with the current value of 261. We bought one at a current value of 612. And that's the two that are hooked together on one ticket. Combined, you can see they're making 7.8% interest or $65. All right. So we've been holding those for 2 days and we've made $65. And then the next one is the single that we put up here. This one is all by itself. I put it in on one ticket. I didn't put it in with the other two. And so it's on one ticket now, all by itself down here. But what if I wanted those all on the same ticket so that I could see them under one header? Because they're all traveling together. I want to see them as if they are one order. I can do that. I can come in here and all I have to do is I just right click. I can right click up here on the screen, this little triangle. See the little triangle? Purple triangles in Track and Trade. That means that they're puts. Blue triangles mean that they're calls. Now, there's some other triangles that we'll see. There's some yellow ones that mean that we got limit orders on them for execution of an exit, stuff like that. But right now, just the purple triangles are puts. The blue triangles are calls, and if it's green, the line is green, that means we bought it. If the line is red, that means we sold it. Okay, we wrote it. We wrote the option. We sold the option to somebody else, not selling the option that we own. I made a big deal about that in class. And it gets a little confusing sometimes because we use the word sell when we sell an option, but we don't actually sell an option. We write an option. If we sell an option, it means we're getting rid of one that we own. So we have an option. So if we sell it, we are liquidating it, right? But we need to say liquidate rather than sell, because it gets confusing. Because if you sell an option, that means you're writing it. That means you are actually putting an option on that you are selling. Okay, so you're not getting rid of one that you own when you sell. You are selling one to somebody, which means you're putting it on. So in the options world, you have to get those straight. And so we need to be very careful with the word sell, because when we get rid of an option that we own, whether we wrote it, meaning that we sold it, or whether we bought it, we need to say liquidate. All right. If we're going to get rid of an option that we own, whether it was one we sold or one that we bought, we need to use the word liquidate so that it makes it clear that we are not selling to get into the market, because we can sell to get into the market. So we don't want to say that, because that could be confusing, right? So it's liquidate when we want to get rid of one. And so we got in here, this is one that we put on the market, and we didn't put it on at the same time. So I'm going to go in here, and I told you I was going to do this yesterday, but we ran out of time. We'll do it today. We're going to add these onto the same ticket. All right. Right now, again, they're different tickets. They have different headers, and so I can't see them all combined. I can down at the bottom. I can see them down here in the bottom, but we're going to add them to the same ticket. And the way you do that is you right click on these little triangle formations, and it gives you a menu, and you can liquidate your option. You can roll your option. That just means close this one and open it up at a different level. We can retrade the single option with a different quantity. Okay, so you can change the quantity on it. We got your preferences, which is going to entail the colors and all that stuff. Text preferences for all the orders. That's whether you want this text on here and how all that text looks. And then you can send it to the back. But to put it onto the same ticket, you have to come down here into your accounting window, and you just right click on this order, and you say, I want to manually link multi-legs. All right, so it automatically links them if you put them on the same ticket and send them into the exchange on the same ticket. But since we didn't, we need to manually link them. So if you manually link them, it pulls up this funny little window right here, and it allows you to move them all onto the same place. So if you read it, it just says double click an option from the available legs. So this is our available legs, to move it to the multi-leg linking area to manually link. When the desired multi-leg is built, press apply. So we have all these available options to us up here, and we clicked on the single. So we should probably actually click on the multi-leg and just add the multi-leg, or the single to the multi-legs, as opposed to what I'm doing now, which is adding the multi-leg to the single. So let's do it that way. We're going to come in here and we're going to right click on the multi-leg, and we're going to manually link the multi-leg. And now we got the two orders down here. And what we need to do is we need to find the one that's not in there, which is easy because it's just the one that's not listed. So we have 6001 and 6002. The one that's not listed is the 6027. So we click on that one. We add it. Okay. Add all legs from this. You can just click this one. I'm just going to put them all down there, but we could just grab the one we want, which is all of them. And then we're going to come in here and just say apply and close. We'll just apply and close. So now what that's done is it put those all three onto the same ticket. So it sent up a report up to the exchange, and then it said, I want all three of these orders to be combined onto the same ticket. It sent back the order and says, okay, we've done it. You're all now on the same ticket. So now you can see they're all down here in the window under one header. So now we're making a gain of combined all three of those orders. Again, this is not some kind of fancy option strategy. It's not like a condor or a butterfly or a straddle or a strangle. It's not one of those. All we did is bought three different put options at different strike prices, just to example what happens when you buy one at the money, out of the money, and in the money. So you can see the difference over time. And so what we're seeing here is that difference. The same thing as we saw over on Apple, we're seeing it on Amazon. The one that we paid the most money for is the one that was deep in the money. So we have a bunch of intrinsic value that we bought, and the gain on that one is 3%. The one that was at the money has a gain of 5%. The one that was out of the money, which is the cost us the least amount of money, has the biggest gain at 6%. All right. The one that's out of the money gives you the biggest percentage gain because you're taking the biggest risk and it costs the lowest amount of money. But you're taking the biggest risk because the chance of the market actually closing or making it down to your purple line and still having that they be profitable is significantly lower than the one that's in the money. The one that's in the money, it's already in the money. It's already making money, right? So they don't give you as much percent gain return. All right. So because you're taking a bigger risk, you get a bigger return. So we're up 6% on the one that was out of the money, 5% on the one that was at the money, and 3% on the one that was in the money. Okay. So that's how we're looking here. And we put all the three of those onto the same ticket. So we can see the header now that puts them all together, combines them. We have a gain of 4.38%, $89, all three combined. Okay. So that is how we put these orders on. Now, to get rid of them, let's say we want to take our profit. We got $94 in here. How do you get rid of them? How do you liquidate this? All three of them at the same time, take your $91. What you do is you right click either on the screen. You can right click on the screen and say liquidate my multi-leg. And you'll notice that it automatically sticks another set of orders on here. These are your liquidate orders. They're on the screen. And then you can see it automatically populates your little calculator over here. So it puts them into the little calculator. And your little calculator over here is telling you how much you're going to receive. You're going to receive $2,123. Well, that's because we put that much money into the market, and then it's going to give us back the money we put in, plus it's going to give us the profit that we have of $88. And it shows you right here. The next line says the net profit is 4.38% or $89. Now to liquidate, this is all purchase. There is no margin. So there's no margin that's going to return, and the buying power is going to increase back up by $2,121. It's going to put $2,000 buying power back into your account. All right. That's how you would liquidate it. You'd come in here. You could bid for it. Again, we're not going to bid for them right now. We're in the demo account. If you want to get rid of them, you just hit market order, and market order is going to just go in, liquidate them off. Okay. And if you bid for it, you can get a little bit better. You can kind of put limit orders in and say, well, I'm not going to take them off unless you're going to give me, it's currently sitting at $89. I'm not going to take them off unless you'll give me $90. So you can bid for them and say, well, I want $90 for them. And then the market will decide whether it wants to give you that extra dollar or not. And you can sit there and bid for them. I want them if I'm not going to take them off unless you give me $95. And so you can say things like that. All right. And then you put your order in, say, I'm not going to take them off unless you give me $95. And the market might come back and say, no, sorry, we're not going to give you $95. And so your order won't be filled. So then you say, okay, all right, I'll take them if you give me $89. And they say, all right, we'll give you $89. And then it takes it off. That's just how you bid for them. All right. That's the bid and the ask on getting in and out of these markets. Okay. So everything's an auction. Everything's an auction. So I'm going to cancel that because I'm not going to get rid of these orders. We're going to hang on to them just so we can watch them. The market started to drop. We went in our favor. We're up $116. If it starts to rally again and turns and starts to go up, we'll start losing money on these options. And then that's where you feel bad. You're like, well, I should have taken it when I was up $100. Well, coulda, woulda, shoulda. That's the name of the game. So let's come over and see what else we got going. We got options in here. Let's go to our positions. We're going to go to all multi-leg. So we saw Amazon, we saw Apple, we have Meta. Let's pull up our Meta chart. And the Meta, and we'll just go for a single. Meta is down here with the same thing. So we did some Fibonacci projections. We played with the Meta. We actually bought one and we sold some, right? So we bought a put right here. So if the market goes down, the put makes money. And the market has gone down enough to outperform the time decay that we're making $52.50 on our Meta. Now, Meta needs to drop faster and harder for that option to continue to be money. It could sit there and still be below our green line. And tomorrow, if it doesn't move, we're going to lose some more time decay, which will be subtracted from our total gain. So we've got to have that market drop. It needs to fall. If it doesn't, that put option is not going to make money. But it started to go back up as of yesterday. It was down here yesterday. And now it started to rally. And so this option that we sold the premium for, okay, we sold this one. It's down $70. So if we liquidated at this point, that option that we sold, we would have to give them back the amount of money we received. We received $5, because when you write an option or you sell it, remember, we're not supposed to use the word sell when we put one on. We're supposed to use the word write. We wrote it. We wrote this option, okay, which is selling it. Okay, it's not getting rid of it. It's not liquidating it. We're putting one on. By selling it, we're putting one on. We're writing an option. All right. So you got to get that terminology straight. So in the process of selling an option, right, we receive the premium. The reason we do that, the reason we write options is to receive the premium. The premium that we receive is the max amount of money that we can make. So this option, we received $550. Now, that $500 is $50 is ours. We can go spend it. And we did, in this case, we spent it on buying this other put option. We put it towards the cost of the put option. So you can see down here, our cost basis when we bought that put option was $1,430. We then wrote an option and they gave us $550. So we used that $550 to subtract it from the cost of the $1,430, which made it our total cost down here of only $880. So $880 was our total cost. So that's how we reduce the cost of the one that we bought, is by writing one to collect the $550. Now, the problem is that we also owe $550 back if we're going to liquidate it. The way we make money on an option that we sell is through time decay. Now, this option that we sold for $550, or that we wrote for $550, has actually increased in value. Okay, it's gone up in value, which means our $770 has lost $70. Now, that's not, we haven't actually lost $70. We only lose that $70 if we liquidate today. We got to keep that $550, and as long as this market stays below that red line right there, we get to keep the $550. It's got to hit that purple line before it hits the red line. That's the game we're playing. All right, little carnival game here. You got into your option, you sold it, you get to keep $550 unless the market, these little ticks on the screen, go up there and go above that red line and stay above that red line, hit that purple line above that white line. It's like throwing darts at the carnival, right? I always think of this as a carnival game. Okay, what do I think is going to happen? Do I think that that market is going to go up and touch this purple line before it goes and touches the purple line above the red line? If it touches the purple line above the red line, I lose all $550. But if it touches the purple line below the red line, I get to keep all $550. That's how this game works with the sell options. All right, it's kind of like a little carnival game that you're playing. So if it, again, if it touches that purple line below the red line, you get to keep all $550. Now, it can do this. It can go up. It can go all the way up here, and then it can come back down. And go up, and it can come back down. It go up, and it can come back down. But as long as it hits that purple line underneath the red line, you get to keep all $550. All right, that's how the game works. And then the call option, on the other hand, when you buy a call option, it's going to have that time decay. So it has to actually hit the purple line. So let's get rid of all these and play the carnival game with the one that we bought. So now we're going to take our dollar calculator and we're going to say we have a cost of doing business. Okay, the cost is the premium that we paid, $1,430, because the guy who sold it to us, he gets to keep that money as long as it stays below that green line, right? But for us, we have to pay that $1,430. So we're going to draw $1,430 in here, $1,430, like this. And then we're going to draw a line across here. That's our break even. That's where our option that we paid for, $1,430, is paid for. The market moved far enough in our favor that it paid the $1,430 at expiration. So we're going to draw a line from where we bought the option, in this case, which was at the money, all the way to the purple line. So right there. So as long as that market stays below that arrow that I just drew, let's get rid of this line. Let's get rid of this one. As long as the market stays below that arrow that I drew, it'll show a profit. Okay, because that's our cost of doing business. That's the cost of that option. And it's going to decay. And as it gets closer and closer and closer to that purple line, it's going to decay faster and faster and faster. So your option has to stay, the market has to stay down here. That's why it's so important. And that's why I was kind of making that little rant and rave about people who just put on these iron condors because it said it's going to make them money. If you don't understand what the market's going to do, or at least have a good idea of what the market's going to do, you don't want to put these options on, because you don't want them to be random. You don't want to just randomly throw these things on the screen, because It's all about how the market's going to move through price and time that's going to determine whether your option is going to increase or decrease in value and what the odds of that are. And so what we do is we use technical analysis to help us decide how far we think markets are going to move. And that's what these mathematical models are all about, right? So if we come in and we say, well, this market moved this far before and it pulled back, that's an ABC pattern. Fibonacci says that that was one retracement. We're going to expect it to do 61.8, 78.6, or 150, 178. Well, there's 161 right there, 161 point. That's close I can get. That's our Fibonacci projection, right? So we can use Fibonacci tools to help us decide how far we think markets can go. If it goes up and makes a Fibonacci 161.1 projection, it would go up to that level. And then it should turn and fall back down, right? And give us a Fibonacci bow tie. Now, if it can go up to 100%, do 100% of what it did last time from B to the A point, which is the break even, and then do that again, this would go up to 200%. Now, do you think it's going to do that? Probably not all in one fell swoop. Probably give us an ABC pattern in there, right? It's coming up and testing and breaking above this previous high right now. So this is where you need to do your technical analysis, and you come in and you draw your Fibonacci rulers on here. You draw your extensions, you draw your time values. You mathematically work out where you think this market's going to go based on Elliott wave theory, based on accumulation distribution models, the stuff that we've talked about in our technical analysis class. And you project where you think these markets are going to go based on those mathematical models. And you just do your best guess. I mean, nobody knows where the markets are going to go, right? But it's better than just I always tell people we want them. There's a wag and a swag. A wag is just a wild ass guess. You're just making a wild ass guess. We want to be a swag. We want to be as scientific about our wild ass guesses as we possibly can, because nobody knows where the market goes. So all of this technical analysis stuff that we're doing, it's just a wag. It's a wild ass guess, but we're going to make it as scientific as we possibly can. So it's a scientific wild ass guess. All right. So that's a swag. We're going to do a swag every time we make a trade, because we're going to do a scientific wild ass guess at where we think the market's going to go. And then we're going to place our orders on there based on that swag or that wild ass guess. And we're going to say, well, I'm comfortable putting my order here because I'm going to swag that market's going to be here. And if it doesn't, then you adjust and you liquidate and you take your losses, or you cut your losers short and let your winners run. But at least be scientific about your positioning into a market before you start putting money on the line. And if you do your swags and you use these mathematical models, you're going to put the odds in your favor a little bit better. Okay. So that's a swag. All right. Let's go over and look at some stocks that people have put up on the screen. So we got, can you take a look at TJX? Scott, thanks for the kind words. Steve Scott saying thanks for the software. Great software. And for being a teacher. I love it. I love doing it. I love coming and hanging out with you guys. All right. This is just my favorite thing. I just do this myself all day long anyway. I figure I might as well share it with people. And we can all come in and do this. I'm doing it anyway. Might as well turn on the screen and let you see what I'm doing. So we're going to come in here and let's go over to our charts, and we're going to pull up TJX. Steve Scott says he wants to look at TJX. Okay. What do you guys see on TJX? Kind of ugly, isn't it? A little ugly. What is TJX companies? Do you know, Steve? Do you know what they do? Let's read it from a Elliott wave standpoint, first of all. So there's our drive 1, there's drive 2, there's drive 3. So we got our 3 drives to the top, right? Now, technically speaking, when we have an Elliott wave, let's draw that in there. We're going to go X, 1, 2, 3, 4, 5, A, B. And we swagged, our scientific wild ass guess said that this thing was going to come down to this point right here, right? It didn't. It failed. It failed to come down and make the full C drive. So this was the low that it made, and I need to readjust that, don't I? So this was the low, which was right here. And that broke that blue light. That's how I know how to count these. Those blue lights from the bulls and bears tells me where these drives are, okay? So now I've got the 5, and that needs to go up on the very top. Be more scientific about it. And know it's a It's an art, but we want to be as scientific about our art as we can. This is a tough one. It's got to be the low point. So right there, broke that, kind of whopped around there a little bit, gave us a little. This is where you're going to get your little wedge formations, right? Your little patterns like this. Okay. So these little triangle formations. Now I put what I call spider webs in here. And so I bring my little spider web in here. And this is where I come in with a natural trend line, mathematical trend line, horizontal trend line. So that's my spider web. Get another one right here. This is your mathematical trend line, your mathematical break, and then your horizontal break. That was almost exactly the same. So that's your spider web. Here's another one. Only this one we go from the other direction. We go here. This is your mathematical model, your natural trend line, your mathematical trend line, your horizontal line. So that's your spider web. If you have my book, shameless plug right here. I thought I was going to show you my shameless plug, but I don't have it up. My book has all this on it. All these all this stuff that we're doing right here. If you want it, if you're in the class, it's in your portal. If you're at the university, there's a PDF in your portal that shows you a book, a PDF that has all this stuff in there that teaches you how all this stuff's done. If you're not in the class and you would like to have the book, you can get it on Amazon. Just search Lan H. Turner and it pops up on the screen and it teaches you all of this stuff that we're doing here with the Elliott wave theory. It teaches you all of this spider web stuff is all in there. All right. So that's what we're looking at. This market failed to break and make a new low, which is bullish, right? If you have a failed pattern is oftentimes a good pattern to the upside. So now what we're looking at is this market came in and now it's made this drive up. So we got a natural trend line, is popped back, broke the blue lights, and now we're getting a downtrend. So there's one up for every down, right? Down, up, down, up, down. Next one is going to be up. So we'll look for a new up. The thing is, we just don't know how far they're going to break. So that's why you look at previous highs and lows. And if it breaks through them, it's going to probably continue to go down to the next Fibonacci projection level, right? So this one is actually showing bullish. In this case, this is actually bullish. It's almost like a little head and shoulders formation. Well, not really, because that head is what I was going to say right there is higher than this one. So that's why it's bullish. Higher highs and higher lows. It's not very clean, but we're coming into what I call third times a charm. So this is your third times a charm. So this is charm 1, this is charm 2, this is charm 3, and usually after charm 3, this is where we anticipate a rise in price. Now, is it going to go straight up? Not usually. Doesn't mean it can't. Go look at the Qs. They went straight up. But it's usually going to go up, going to go down, going to go back up, right? So that's kind of what we would look for on this market. As long as, we have positive economic news overall. And of course, depending on what this company does. Let's see. John David Lumberg saying, Lan, did you buy options on the Qs at the end of the October when you set out to buy the Q? Wish I'd done. I did not buy options. I just bought a whole bunch of shares. I should have, hindsight. Woulda, coulda, shoulda. Wish I had done it with options. No, I just bought a whole bunch of shares, and I still got a whole bunch. The market's still rising. I've been taking profits as the market continues to rise and hit specific price levels. So I try to trade like the big hedge funds, right? I accumulate down low, down in these regions. I accumulate down low in these buy zones down in here. I just start accumulating, and then I anticipate a rise in price, and when it starts to go up, I start to liquidate, take some off as I make money as the market rises. So I've been taking some off. I still got a pretty good little holding up there. I'm waiting for a final distribution, and on the Qs, I didn't do options. I wish I had. It's funny, my mindset. I get my head into doing certain things based on what I'm teaching, and I haven't been teaching options, and so my head's not been in options. So I just kind of didn't think about doing it with an option. I'm getting my head back into options because I'm now teaching it. So I'll probably start trading more with options. It just kind of seems that's the way it goes with my brain. All right. Anybody else got one they want me to look at? We got, we'll look at one more. Could I still purchase your book as a PDF through the Trade Mentors site? Abert wants a PDF version of the book. It used to be there. But we've been doing so many updates on the website. I'm not sure if you can buy the PDF version. I'll go look, Abert, and see if it's there after this class. If it's not, I will ask the boys to put it there. I'll ask them to put it back on there. I know it was there, but we've kind of done this thing. That's why we had so many problems with all of our DNS and nothing worked for a little while. We broke it. You had to break it to fix it, right? So we wanted to fix the website, but in that process, we broke it. And I'm not sure how those it used to be there. Not sure if it's still there. I will go check, and if it's not, I will try and get it up there for you so you can buy the PDF. The PDF was like half the price of the paper book to buy it, so we'll see if it's still out there. But the paper book's not expensive. It's like what, $33 or something. So I don't know. We'll go see. I'll go see for you. That's a good question. Anybody else got another stock? Otherwise, I'm going to go pull up one real quick. I'll pull up another list I've got in here. Portfolio 7. Let's look at these. We got Arlington Assets. That doesn't look exciting. We got Boeing. Boeing looks exciting. All right. Boeing. Drive 1, Drive 2, Drive 3. I bought a bunch of Boeing right here as it started to come up out of this third drive on the accumulation model right here. That was my signal right there, which corresponded with the bulls and bears, and I bought a whole bunch of Boeing. It made that little flag formation right here, right there, and I bought a whole bunch more right here as it started to break out, and I'm still in Boeing. I've got Boeing right now. It's getting another little flag formation. It's probably time to take a little bit of profits off, but it looks like it's breaking higher. So I'll probably hang on to it for a little while longer and see what it's doing. If it's going to come in there, we should probably take some profits on Boeing right about now as we hit this 50% level on the Fibonacci retracement. So that's our Fibonacci ruler. It dropped down through the 3-drive pattern, drive 1, drive 2, drive 3. Now it's rebounding. It's back up to 50%. So what it's going to probably do, right? We probably expect it. It might go up to 61.8. We're going to watch and see. It just broke a previous high today. So, but I'm expecting the market to make a little rebound before it does an ABC. I will expect an ABC out of it. That's just profit taking. People who got in down here are going to want to take some profits, and then they're going to want to run it back up again. So we'll watch for an ABC. It's right dead center of the Fibonacci sweet spot right now, which is between 61.8 and 38.2. So that's where that's at. If that thing comes down and makes a beautiful, perfect little trend, breaks those blue lights and starts to rally, that would be a great place to buy an option as we anticipate the next leg up on that ABC retracement Elliott wave pattern. All right. That would be a nice probability for us to take an option right there. Bank of America already made the little ABC. Again, we had a 3-drive pattern. The reason this is here, this list, this portfolio 7, I'm in all these markets. Okay. Full disclosure, I own every single thing in that list. And here's the reason why. Drive 1, counter trend. Drive 2, counter trend. Drive 3, thing took off, went to the moon. There's our break, green to red, third drive, right there. Boom, buy. Market comes in. I did not do options with any of these. I did shares on every single one of these things. I need to start getting back into options again. Okay, so then the market pulled back, created this beautiful little, let's do this correctly. Well, that would be correctly. This is the one right here. Made this beautiful little wedge pattern, little triangle formation, broke out of the wedge pattern right there and back up. So if we take the Fibonacci ruler and go from the top to the bottom, we're right at 61.8. Today, we're hitting that 61.8. I'm going to, after this class, go take some profits. I'm going to take a little bit off. Not all of it, because it doesn't mean it can't keep going up. It certainly can, but I do want to take some profits as it reaches some of these target points, just like the big speculators, right? As we've talked in the past, they loaded up down here in all these green spots. That's where they bought all their shares. And then as the market rallies up, that's why this is red. This is where they're selling out, taking profits. This is why this market rallied up and then it pulled back and created that little flag formation, is because that was profit taking. And then it took off and ran again. Now we're going to expect some profit taking, and then maybe it'll jump and run again, give us another opportunity. If it pulls back, we're at the top of a third drive. I don't want to buy an option. Okay, I don't buy options at I don't buy options going into a C drive. So this would be a fractal A drive, fractal B drive. If it pulls back, we'd look for a fractal C drive. I don't want to buy an option going into a fractal C drive. I want to buy my options. My favorite place to buy options, bottom of a third drive right here. That would be a great place to buy an option. Shows you down here, but also going into the C drive or the B drive. So this second drive is the B drive. That would be a great place to buy an option as well, that breakout right there. Do not want to do the C drive. Now remember, A drive, hors d'oeuvres. B drive, meat and potatoes. C drive, dessert. I don't ever try to go and get the dessert with an option. All right. Okay, here is Global Robotics Artificial Intelligence ETF bots. So we got same thing. You just see my trades all look the same. I do the same thing. Drive 1, drive 2, drive 3, counter trend, bottom of the third drive, buy as it comes up out of that green arrow right there. Go into the ABC pattern. I still have this one. I own it. It's coming in. It gave us the little flag formation right here. And up it's going. Do the Fibonacci retracement level. People say, well, the stock I want to trade isn't making those beautiful little patterns like yours, Land. Sure, it's easy for you. Your stocks are making those little patterns, but my stock doesn't make those little patterns like that. It's not making these 3 drive patterns. Well, then don't trade it. That's my answer to that. Don't trade it. If it's not doing what you want, don't trade it. If you can't scientific wild ass guess what you think it's going to do, don't trade that stock. We only trade the stocks that are doing what we want them to do. Drive 1, drive 2, drive 3. I bought right here. Boom. I'm still in it. Taking profits right here. There it is. Just like that. Looks like it wants to go up, but we are at the Fibonacci level. So we're right here at 61.8. That's strong resistance right there. We need to take some profits. Not all of them. We'll have a stop in here in case it breaks lower to get out and take our profits. But we're going to anticipate there's the possibility it could continue higher. So, but we do want to take some of our profits right there. General Dynamics. This one was kind of ugly, but we went into war. So you buy General Dynamics. Drive 1, drive 2, drive 3. We have the little break right here. The break right here. And that market took off like a rocket ship. And I'm still in it, but it is coming in, getting ready to make this wedge pattern, which means we're going to look for it to break out the bottom. Profit taking, how far is it going to come back? Put your Fibonacci ruler in there and make a wild ass guess. It's probably going to come back somewhere into the Fibonacci sweet spot. This is where people will drive it to take their profits, and then it'll probably go sideways a little bit, do one of these little dances, and then it'll take off and go back up again. All right. Unless they, have a ceasefire and stop the war. War is good for some markets, and then down this thing will come. No war, no good stock. All right. Goldman Sachs, same thing. 3 drive pattern. Drive 1, drive 2, drive 3. Flag formation right here. Fibonacci ruler, top to bottom. See, it just gets monotonous after a while. You just do the same thing over and over and over again. Take some profits. Don't take it all because it could continue to rally, but have a stop in case it flushes. All right. JP Morgan. Drive 1, drive 2, drive 3. Counter trend. Now, I will say I wasn't perfect timing on all of these. I put shares in right here. So that was perfect timing. But I also put some shares in right here. Okay, on most of these I did. I put shares in on the second drive. So I dollar cost average in, not that one. This one I did. I bought some right there. Bots, I bought some right there. Back, I bought some right here. Boeing I didn't. I just bought it right here. Arlington, yeah, I think I did. I bought some here and I bought some here. So this is drive 1, drive 2, drive 3. So I start buying in on drive 2. I don't buy X1, SA1, right? Remember that? This is your first X1, SA1. Lowest probability of success right there. But when an Elliott wave finishes its Elliott wave drive, right? Elliott wave goes X, 1, 2, 3, 4, 5, A, B, C. Once it does that, A, B, C back down the other side, we anticipate usually what happens is a market will kind of go sideways a little bit as it kind of decides that it wants to go through the accumulation stage, and then starts to rally once again out of the C drive. This time, all of these stocks that I have in here made a third drive down, right? They went up. So I started to buy thinking that we were going to get a good place on that next drive, and it went down. So then the probabilities were even that much further in my favor. So that's why I put on, I went in gentle here, went in, got some nice shares, but then I had to dollar cost average in and put the rest of them in down here. So on the third drive down. Now, if it would have gone up and made a fourth drive up, oh, come on, give me the right tool, up and then come down and it's gone up, I'd have had to do a little more dollar cost averaging and add in on the fourth drive in anticipation of the rally. But I start at 2. I don't start at 1. The reason I don't start at 1 because it's a real low probability of success. I always wait X2S A1. That's my first entry. First entry, and not with a huge share size. Because why? Because you might get that X3S A1. And that's why. So X3S A1. All right. So those are the two I start dollar cost averaging in on. Those are my entry points. So where did we get to? JP Morgan Chase. We talked about that one. There's the Qs. Of course, the Qs did the perfect 3-drive pattern. Drive 1, drive 2, drive 3. So I started putting in on the Qs. If you watched my video, I gave a notice. I said, I'm buying the Qs right here. And I did. Came up, came back down. Then I was like, oh, crap. Got to buy some more Qs right here. So I bought some more, and we're long the Qs. Where's it going to go to? Well, we've got it up here testing this previous high already. So it broke past this Fibonacci sweet spot like it wasn't even there. Just didn't even look at it. Came up, made a kind of a little tiny, tried to make a little flag right there. And I took some profits on that little flag right there. As you can see, it almost didn't even make a flag, but it tried. And then it made another little flag right there. Took some more profits, and now it's up here testing this previous high, and it looks like we should probably take some more profits right there. So I'll probably do that after we get out of, I'm going to take some profits right there in anticipation that there's a possibility it could come back down into the sweet spot and then rally again. Does it mean it has to come all the way back down into the sweet spot? No, the market can do anything it wants. We're going to do our scientific wild ass guess, and that's what we're going to guess the market's going to do. Tesla, drive 1, drive 2, drive 3. Drive 1, drive 2, drive 3. So there we go. I bought some Tesla right here. I did. Do I still have it? I do. Am I down? Yes, I am. But that doesn't matter because right here, when it broke above that, I bought some more Tesla, and it's pulling into a little flag. I dollar cost averaged in. I'm about to break even right now. Where's my little flag? We're going to buy some more Tesla. I'm getting ready to buy some more Tesla right here in anticipation of a rise in price. Okay. So right in here, you can see there's my crossover. There's where I got in. I timed it with the market. Away we go. Upstart. Yes, I have some Upstart. It's one of my laggers. I'm a little bit disappointed in it. Gave me some confidence because this thing went so hard before. I thought that would be a good 3-drive pattern down. So we got drive 1, drive 2, drive 3. I started buying into this thing right here. I have to buy some more here. And now we're on a 4th drive, and it's just not doing anything for me. So this one, I'll probably give it one more shot. If it doesn't give me some boost and get me out of here, I'll probably lose a little bit of money on that one. Zion is good to me. I made a lot of money on Zion because I caught this little drive here. I thought it was going to be a full 3-drive pattern. It wasn't. Ended up being a 2-drive pattern. So that one I made a bunch of money. And then I thought we were going to go higher. So right here, I bought some more. Right here, I bought some more. You're like, oh, man, that's your X3A1. No, it's not. That's going into the C drive on the upside. So I thought that was going to be the C drive, and we were going to get another break. Looking for it to come up, test this previous high. I want to see it break above that high. It didn't happen. It flushed down, and now we're down here licking our wounds a little bit. Had to give some of our profits back, but that's drive 1, drive 2, down, drive 3 coming down the other side. And I've been buying back in, trying to recover some of my Zion drawdown. But we're back up to almost break even again on the new purchases of Zion, and still up big from the previous run, but not, this new run is not doing quite as well as the last one. But I'm looking for this thing to continue higher, and that's what I'm looking for on Zion. All right, guys. We've kind of gone over an 1.5 hour long class today. We did both a little day trading, got our heinies handed to us. we're going to go look at crude oil when the report comes in and see if we can't make a little bit of that back. And that's a little bit rundown on the options and on what's going on with the current market analysis. If you guys have any questions, please let me know. The insights, the stock platform's been very insightful. Ebert, thank you. I'm glad you've enjoyed it. And Ebert says, just started using the track and trade futures, and I love the layout and information presented in the index. I may now have to look at the stock version. It's sweet. It's a sweet tool. It's designed specifically for this type of trading. And if this is the type of trading you like, if this resonates with you, hey, there's no better platform. So come and stick with us. Come back. Everybody, if you enjoyed today's class, hit that little like button. Give me some thumbs up. YouTube algorithm always likes that if you guys give a thumbs up. And any comments you want to make, it's great to have your comments in here, but it's also great to have comments in the comment section underneath the video. YouTube algorithm looks at that too and says, hey, those people are engaging with his video. So thumbs up and comments are always great. And I appreciate it. John Mackey, thank you very much for your kindness. You're always got nice things to say, and I appreciate that. And I'm going to let you go for the day. Have a good evening. It's a Friday. Have a good evening tonight. Take your sweetheart out. Go spend some of this money you're making in the financial markets. Feels good.